Millions of retail traders treat the market like an art class. They print out a static cheat sheet, draw symmetrical triangles on a chart, and expect the market to deliver a perfect geometric breakout. That illusion shatters under the weight of high-frequency order flow. There is a massive disconnect between how amateurs and professionals operate. Retail traders rely on passive, symmetrical geometry. Institutional algorithms execute on predatory tape physics. The machines do not care about your trend lines. They care about trapped capital. Those static support and resistance lines you draw are visible to the algorithms. In fact, high-frequency desks actively use standard retail indicators as bait. They engineer price movements specifically to trigger your technical signals, forcing you into the market right before a violent reversal. Single timeframe charting is entirely backward-looking. It tells you where price used to be. Institutional execution models are forward-looking. They calculate exactly where large pools of liquidity are sitting right now, and they map the exact mathematical coordinates required to sweep them. To survive this environment, you have to abandon the flat, two-dimensional chart. You need to build a four-dimensional matrix, a system that actively cross-references time, multi-layered gravity, internal volume telemetry, and pre-calculated risk. Professional execution relies on architectural engineering against predatory machines. Reading the true algorithmic constraints of the tape is the only way to avoid becoming liquidity for the desks across from you. We start by securing the z-axis, market gravity. When traders execute based solely on a 5-minute moving average, they are looking at a single gear in a much larger machine. Without higher timeframe context, that local line often fails to act as support. A deeper, hourly gravitational pull is dragging price toward a macro mean. Look at this diagram. The solution is to native project 3 specific higher timeframe anchors directly onto your fast execution chart. We overlay the 15-minute momentum highway, the 30-minute fair value line, and the 1-hour macro baseline. This maps the exact depth of institutional gravity. When these gears lock in sync, we get a pristine stack. Notice how the 3 lines uncoil and fan out in pristine sequential order of speed. Price rides cleanly on top. This geometry indicates accelerating institutional velocity. In this state, the rules of engagement are strict. You do not fade the trend. You only take reload entries on a micro pullback down to the fast 15-minute momentum line, catching the institutional algorithms as they aggressively lift the offer. But the market breathes and the gears occasionally fail. When the sequential order shatters, we enter the mixed blender. The moving averages cross, tangle, and flatten into a knot, while price violently oscillates straight through the center. The physics of the mixed blender reveal total timeframe desynchronization. The fast attack 15-minute sellers are aggressively pushing down, while the macro 1-hour institutional desks are buying the floor. They are actively grinding against each other. Retail traders see these rapid green and red candles and overtrade, getting sliced from both sides. The actual alpha generation strategy here is extreme discipline. You stay entirely in cash. You protect your capital by refusing to execute until one timeframe overpowers the others and restores sequential order. Market momentum operates as a massive multi-gear machine. If those higher timeframe gears are out of alignment, the net directional vector is 0. You step aside. Moving to the y-axis, we have to address a lethal spatial flaw in standard retail trading. Most platforms draw an initial balance by simply drawing a box around the absolute high and low wicks of the first hour of trading. On this diagram, watch what the high-frequency algorithms do with those wicks. They push price exactly 1 tick above the retail high to trigger a flood of breakout buy orders and short stop losses. The moment that liquidity is harvested, the trapdoor opens, and the price collapses violently back into the range. We replace those outer wicks with the DRW 3D block. Large institutions do not build their positions at the absolute extremes of a candle. They accumulate assets inside internal compression zones. By dividing the session into 20, 40, and 50% quadrants, we map the actual distribution of volume. The 50% midline acts as the absolute session fair value. It serves as the ultimate filter. If the live cash settlement is trading above this line, the daytime algorithms maintain a strict bullish bias. If it drops below, the bear's on the tape. The true structural defense sits at the 40% edge lines. These are the hidden boundaries where the institutional cash settlement actually hardens. They represent dense walls of resting limit orders built quietly inside the visible chart extremes. During an institutional expansion day, you execute your reload entries safely off these 40% walls. Price pulls back, strikes the concrete edge of the settlement zone, and is cleanly rejected upwards. You place your risk directly behind the wall. True support and resistance are never found at the isolated extreme edges of price action. They exist deep within the internal compression zones, where billions of dollars in cash actually settle. Next is the x-axis, time. The critical oversight of the amateur trader is treating all breakouts as equal. A breakout at 9:45 a.m. does not carry the same mathematical weight or intent as a breakout at 11 a.m. Order flow runs on a strict schedule. Watch the clock on this diagram. From the open until 10:30 a.m., the algorithms are in price discovery mode. They are actively defining the range. But at exactly 10:30 a.m., the 60-minute volume window closes. The mathematical boundaries harden from discovery mode into a locked concrete cage. This pre-lock spike is pure manipulation. It triggers impatience and FOMO in retail traders who assume they are missing a sustained opening drive. They buy the open air, anticipating a massive trend day. 5 minutes before that lock, at exactly 10:25 a.m., the machines deploy the Judas trap. Price violently spikes above the developing top boundary line. Then comes the Warden sweep. The exact second the clock strikes 10:30, the buying algorithm shuts off. The cage locks, and the price immediately collapses back inside. The auction failed. Every retail trader who bought the 10:25 breakout is now trapped outside a concrete wall. The structural consequence of this failed auction is severe. The algorithms instantly flip their bias, using the panic selling of those trapped breakout buyers as jet fuel. The mathematical target becomes the absolute bottom boundary of the locked cage. You cannot trade geometry without trading the clock. If you fail to synchronize your execution with algorithmic time windows, your capital simply becomes liquidity for the machine's schedule. The final module requires completely decoupling your analysis of visible price action from internal volume. Reacting to a price candle in a vacuum without checking the underlying data telemetry is like flying a commercial airline completely blind. This split-screen layout shows the difference between price and momentum velocity. Think of a sports car hurtling down a highway. If the driver takes his foot off the gas, the car is still moving forward rapidly, but the speedometer drops from 100 to 90. The lower panel histogram measures that loss of acceleration, even while price continues down. This dynamic creates the B-wave trap. The market makers engineer a deep pullback, driving the price down to a sharp new low on your chart. Retail traders see the breakdown, panic, and aggressively hit the sell button. But the data telemetry reveals the lie. Look at the volume footprint underneath that new low. It registers as ghost volume. The bars shrink to almost nothing, proving there is a complete lack of actual institutional selling pressure participating in the drop. We confirm the trap by tracking CVD absorption. While the top panel shows price making a lower low, the cumulative volume delta on the bottom panel prints a higher low. Massive institutional iceberg orders are sitting at the bottom wick, quietly absorbing every single retail stop loss without letting the real delta drop. Once the retail selling is completely exhausted, we get the true C-wave ignition. Institutional capital steps heavily back on the gas. A massive volume spike registers on the telemetry, and the algorithm aggressively reverses the market upward to hunt the stops of the trapped retail shorts. Price action is merely the lagging symptom of market behavior. Internal order flow telemetry, measuring the exact velocity and weight of the capital, is the true cause. A standalone signal, an isolated wave pointing up or down in the middle of empty chart space, is mathematically unreliable. It lacks structural anchoring. Trading it is a low-probability gamble in open air. Professional execution requires the nuclear junction. Here, the dynamic moving average, 40% edgeline, and locked time marker intersect at one specific tick. This aligns trend followers, cash desks, and macro funds. This mass buying event creates heavy directional pressure to clear retail stop-loss clusters. Before you execute at that junction, you must define the downside. The command center hard codes your risk upfront. It calculates the live volatility of the session block, using a strict formula to determine your exact point risk before you ever enter the trade. You adapt this math based on the environment. During wild, expanding volatility, you deploy the conservative shield, scaling down your contract K-load to protect capital. But during tight, high-conviction cage compression at a nuclear junction, you deploy the aggressive hammer, leveraging up heavily against a microscopic structural stop. Regardless of the profile, the ultimate rule is unconditional structural invalidation. If a price candle prints a clean close outside the 40% wall, the institutional cash settlement structure has failed. You exit the market immediately. You remove all hope, all fear, and accept the engineered invalidation. Stop hunting for geometric art on a static canvas. Elite execution is the result of mapping the tape. Master the physics of multi-timeframe gravity, internal volume telemetry, and structural convergence. Map the matrix, lock in your risk, and go hunt.